please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The management of one such company on board, Zensar Technologies Q4 was a mixed bag as the margins declined, but the other income supported the profit. The board has also approved a stock split in the ratio of 10:5. Sandeep Kishore, the MD and CEO of Zensar Technologies, joins us now to talk about that. Sandeep, thanks for being with us on CNBC TV18. The worry that the street has is the fact that your constant currency growth has slowed down quite a bit. If you look at the last 4 quarters, this quarter has just come in at 1.1% versus, 3 to 3.5% that you have done in the past few quarters. Is this a trend that we can expect in the next few quarters as well?
I think, we are executing quite well. On the US dollar term, this is our 4th consecutive quarters of 3+%. 1.1% on constant currency that you're seeing is largely on account of US, which grew about 1.5% on constant currency. And given that US is about 70% of our market, it does kind of weigh itself in. We are executing well to the digital strategy. Digital actually now in last quarter grew almost 8+% sequentially and 35+% year-on-year basis. So the plan that we have for being in the digital space, actually we are quite pleased with the performance that we are delivering. Our PAT also, as you called out, grew by almost 7% on year-on-year basis and 23+% on a sequential basis.
Okay. Well, morning, Sandeep. Can you give us some idea of what the outlook is? Do you see more orders coming in, considering that the US is in a seriously proven growth phase, and therefore can we expect an improvement in margins as well? Are billings improving?
So, we've actually announced 2 of the large deals in the last 12 months, which are north of $50 million plus TCV deals. And that will start to play itself in as we go into fiscal 19 for us. And when you drive scale, we do believe it will have its play into the margin as well, because you have better levers of efficiency to impact. The second, obviously, interesting input is the automation. As you start to add more and more work, which is delivered from offshore, you have a propensity to do more through automation. So we feel pretty good that, you will see an uptick into the margin as well.
Okay, would you quantify it? Because this time the EBITDA margins fell a bit, that's why I'm asking.
Yeah, we don't give forward guidance, but the reason EBITDA margin actually fell down is because we had to take a provision for one very specific customer in the US retail sector. But on an operating basis, if you take that one-time extraordinary out, I think the EBITDA margin actually is pretty good.
Okay, I just wanted to come back to the digital strategy because, that's the new buzzword in the IT space. You spoke about an 8% growth this quarter. What do you see as a sustainable trend? And more importantly, as a part of your overall business, currently it's 40%. How much do you think it could grow to?
So digital is the main pivot for our growth. If you take a look at over the last 2 years at Zensar, what we have been driving, we've almost doubled our digital business. So we are now running, at about $50+ million on a quarter for digital business. And I do feel, based on the pipeline that we have and all the platform that we have developed in Zensar, that you should see a momentum of 8+% sequentially on the digital business.
Okay. Just a final word, therefore, what kind of growth can you talk about? Is there any guidance you can give in terms of either constant currency or dollar revenue growth?
No, we don't give forward guidance, but if you've seen the trending in fiscal 17, year-on-year, we actually grew by about 1.5%, fiscal 18 by about 5.8%. So we are pretty confident that you will see a higher growth than what we have delivered last year into fiscal 19.
So NASSCOM's guidance for the full year of FY19 is about 7 to 9 odd %. You think you could fit into that bracket?
We'll certainly try and beat that.
Oh, okay. All right. That's a pleasure. Sandeep Kishore, thank you very much for joining us.